When we think about what opportunity has been available in credit in the last 5 years, we've seen both individuals and funds allocate away from credit just because the returns that were available were so paltry. And when we think about what the opportunity is going forward, we think there's just much more return that's going to be available on a more sustainable basis for investors. So we see this as a time where investors are going to be increasing their exposure to credit. Both individuals and institutions will be increasing their exposure to credit and trying to rebuild some of that recurring income that historically played a big part of portfolios, and it just diminished as part of portfolios in the 2010s because there was so little income available. We think that bank loans are more attractive than high yield bonds. When we think about what's happened in the rates market over the past 2 to 3 months, you've seen a big rally in the 10-year as market participants have gained conviction that the Fed was going to quickly stop raising rates and also would start cutting rates. While the market has gained that conviction, spreads in the high yield market have also come tighter. And so that combination to me feels somewhat overdone. I think that there's a scenario where if we continue to get strong economic data like we did last week with the jobs report, that market participants are going to have to capitulate on the speed with which they think the Fed is ending the rate hikes. And so that's a risk for the high yield market. On the loan side, we haven't seen loans have less interest rate sensitivity, so they haven't rallied with the 10-year, and we've really seen spreads stay at a wider level. They've rallied to some degree, but in a much more muted way. And so between those two asset classes, I like loans, the U.S. loan market better than the U.S. bond market. I also think that there's I would also say a special mention for CLOs, which are portfolios of U.S. bank loans. It's a structured credit structure, and we think some of those tranches are really attractive. Leveraged credit markets are traded loan and bond markets. There's also a private credit version of these markets. That's not where my team spends its time. Typically, these are businesses that are going to be sub-investment grade, so they're going to be rated anywhere from BB down to CCC. And in many cases, they are private equity sponsor-backed businesses. So private equity sponsor identifies a business that they want to buy. They buy that business. They put in 30 to 40% of capital to support the purchase of the business, and then they borrow, most typically in the loan market, although sometimes the high yield market, they borrow the remainder of the money against the cash flows of the business. And so what we specialize in is assessing the durability of those cash flows, the downside protection that these businesses have, and try to identify the opportunities that have strong durability of cash flow, the companies that will be able to have no problem paying us back, and where we can earn an attractive spread for making those loans. One of the things that we've developed since we started KKR Credit in 2004 is just a very structured investment process. So we run a morning meeting every day where one of the analysts will report out the economic news of the day. One of our traders will report out trading environment that they're seeing in the morning, and then individual analysts will highlight relevant news for all of the companies in their portfolios. In addition to that, then my co-head of research and I, Terry Ang, will run a prioritization meeting. So we sit down with all of the analysts once a week and go through how they want to allocate their time for the coming week, what businesses they're diligencing, what opportunities they're chasing down. After that process, we have 3 types of investment committee meetings. We have a screening process where analysts can come with just the most rudimentary sketch of the opportunity where we can give them feedback on whether it looks interesting or not. We have office hours where we're expecting analysts to come with somewhat more prepared material. We expect them to have done more of the work assessing the durability of cash flow and downside protection. And then finally, we have our formal investment committee where they're coming with several pages that detail the way in which the company makes money, a 3-statement base case financial model, a downside case model. We ask them to inform the downside case model by looking at historical periods of stress in that industry. And then to the extent that we approve the credit and we end up investing in it, we then augment the monitoring with what we call our portfolio management committee, which is once a month the analysts once a quarter the analysts update all of their models, submit those models, and we sit in a conference room for the better part of a week and kind of re-underwrite the portfolio.